Okay, with that, I'm now recording the meeting, so I would like to call the regular meeting of the Retirement Board to order at 9:07 a.m. The first item on the agenda is approval of the meeting minutes from our December 2nd, 2020 Retirement Board meeting. Could I get a motion to approve the minutes?
So moved.
Thank you, Tim. Could I get a second?
Second.
I think that was Elliot and Craig maybe there. Thank you. Are there any corrections or changes that need to be made to the minutes? Okay. Hearing none, all in favor of the minutes as presented, say aye.
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 Any opposed, state your name and that you're opposed. Okay. The minutes are unanimously approved. I would now like to turn it over to Devin to go through the defined benefit plan portfolio performance.
Okay, good morning, everyone. Good to see you all. So I'm going to share my screen. Hopefully you can all see this. And let me just make a couple adjustments so that I can still see all of your faces. Okay. So this quarter, what we'll do is go through the fiduciary governance calendar. We do have a portfolio recommendation as well, so I'll go over that. We'll do capital markets review and a big picture portfolio review. I acknowledge that there are other items on the agenda and we want to wrap up by 10 o'clock, so I'll be somewhat brief. On pages 2 and 3 of the report that was sent out, we have just a quick firm update. So I think all of you are aware that in addition to working with municipal pension plans, we also oversee obviously municipal defined contribution plans as well, and corporate and nonprofit defined contribution plans, as well as endowments and foundations and private clients. So a lot of different lines of business. We reached 195 billion in assets under advisement, and that was as of June 30th. So certainly as of year end, given the strength in the markets, we are well north of 200 billion across the firm. And we have been pleased to be able to add some new team members, even despite the pandemic and everyone working remotely. Most importantly, we've added a chief compliance officer and a chief operating officer over the course of the past year. So those are clearly two key positions. And then finally, on page 3, you can see that this year we were ranked the #1 institutional consulting team by Barron's, which was quite thrilling for us, pretty exciting. And we were again named to the list of best places to work in money management. That's been several years running. And the reason that that's really important to us is simply because that means that our employees are happy. When our employees are happy, there's less turnover, so that creates continuity for our clients and a better client experience. So those are all things that are meaningful to us, and we're happy that given the integration with DeMayo, things are moving along well and the integration is going very well. So this quarter for the fiduciary governance calendar, we have a focus on asset allocation. And we will share with you our updated capital market assumptions, which leads us to our expected return for the portfolio. The reason that that's important is because you have your stated actuarial return assumption, which the folks at Hooker and Holcomb are using to create the valuation. So it's important that the asset portfolio and the actuarial return assumption are working hand in hand and are well aligned. So we'll go through that exercise, and then, as I said, we'll share all of the other portfolio recommendation and the capital markets review and all that. So just a quick snapshot on page 7 for the most recent valuation report. So we have the 2018 and the 2019. I know that Stefan is working on the 2020 report right now. So the good news is that in 2018, you were using a return assumption of 6.625. You did move down to 6.5% between 2018 and 2019, but your funded status did not suffer at all from that movement. So, you made the move at a good time where asset growth was enough to kind of make up for the lowering of the return assumption. And then at a most recent meeting, the decision was made to further reduced this number to 6.375. So that's a prudent decision from our perspective. We've talked about how return assumptions have really come down across the board, and I'll talk about some of the specific figures, but we do think that that is a prudent move. So one of the things, in addition to making sure that the portfolio is appropriately aligned to help you meet your expected return assumption, it's also important to verify that we are within the parameters established within the IPS. So here on page 8, we show the allowable ranges that are stated in the IPS, the target allocation, and then the actual current allocation. So what you can see is that right now we are underweight fixed income and overweight domestic equity compared to our targets. And that is by design. And I'll talk a little bit about the investment landscape and why we are not particularly constructive on fixed income. But it's important to note that even though we happen to be underweight fixed and overweight equities, we are still well within the guidelines that have been established within the investment policy statement. So we are fully in compliance with the IPS, no concerns from that perspective. So our capital market, I won't go through all of this information. I believe you know, but I'll reiterate that we review our capital market assumptions on an annual basis. We create both 10-year and 20-year return and risk assumptions. And what we use in the exercise for our pension clients is our 20-year assumptions, simply because the actuary is using a very long-term time frame. So it's appropriate for us to be using a similarly long horizon. So what you can see on page 11 is here, this first column of numbers represents the most recent capital market assumptions. The column next to it represents the assumptions as of last year. And then the final column shows the year-over-year change. And what you can see overwhelmingly is that the change has been to the negative. So last year, our expectations looking forward were more optimistic than they are now. So why is that? Well, it's for a couple of different reasons. One, on the fixed income side, is the very low interest rate environment. So over the course of 2020, interest rates, if you take the 10-year treasury as kind of a broad proxy for the bond universe, the 10-year treasury started the year at about 1.9%. Over the course of the year, it came down, ended 2020 at about 90 basis points. So the 10-year treasury was yielding less than 1%. It actually dipped down to about 50 basis points during the year, but then did rise up a little bit again. So the starting point for interest rates is very low. When you think about fixed income returns are comprised of two components. There is the price return and there is the interest rate return, or the yield. So the yield, which is the coupon that you get from your bonds, very low because interest rates are so low really across the board. So in treasuries, in corporates, in high yield, we have very low, historically low interest rates. The price component of fixed income, you'll remember I have mentioned in the past that bond prices and interest rates have an inverse relationship. So as interest rates come down, bond prices go up and vice versa. So that was a tailwind for fixed income investors last year because you had falling interest rates, which meant that bond prices were rising, which meant that you had a very strong return from the price component of fixed income last year. That is not likely to continue to be the case for a couple different reasons. First is that the expectation is that if interest rates do anything, they are more likely to rise than they are to fall. Now, of course, interest rate speculation is a futile task a lot of times. So we're not necessarily making a prediction that interest rates will rise, but the likelihood is that they are more likely to be increasing rather than decreasing. And then the second part of that factor is that because interest rates are so low already, even if they did fall and you had a positive boost to prices, there's not very far for them to fall. So when you think about those two components of fixed income returns, yield and price return, we're not optimistic really about either one of them. That's a very long-winded way of saying that we don't expect much return from fixed income. So for instance, you can see here the return expectation for the US bond market is 2.1% over the next 20 years. That's a nominal return. So if you strip out inflation, you're essentially looking at zero. If you think of inflation at about 2%. So that's why our fixed income returns have trended lower, is because of the current fixed income environment and very low interest rates. Our return assumptions for equities have also trended lower simply because 2020 was such a strong year for the equity markets. And we'll take a look at the index returns page and you'll see some of those numbers. But every time you have a really gangbuster year for equities, that means that equities become more expensive and there's perhaps a little less room for them to grow. So that's why you see a downside return assumption, a return assumption that has been revised to the downside really across the equity spectrum. If we look at kind of the investable universe, our highest expectation is within the emerging markets with a return expectation of 9.4%. But of course, in emerging markets, you have additional volatility. So it's that whole, risk return profile that you need to keep in mind. So this kind of sets the stage. These are all of our capital market assumptions for the next 20 years. And this is what's called the efficient frontier. So here on page 12, you have this curved solid line that represents the efficient frontier. So for every point along this line, that represents a portfolio that, given a certain level of risk, has the appropriate combination of asset classes to produce the highest possible return from a statistical standpoint. So this is purely a mathematical exercise. It's not a prediction of what is going to happen, but it's, kind of putting all the pieces together, making an educated guess as to what we can expect from the portfolio. So so the good news is that these light blue A and B bubbles represent your current and your target portfolio. The good news is that those are on the efficient frontier, meaning that the makeup of the underlying asset classes is an efficient blend. So what does that translate to in terms of what we can expect from the portfolio going forward? So if you look up here at the table, you can see that portfolio A in the lighter blue represents the target allocation. So going back to that investment policy statement, portfolio A is this column here with 35% to fixed income, 35% domestic equity, so on and so forth. Portfolio B represents the actual allocation with only 30% in fixed income. So you see that B is a little bit further up on the efficient frontier, meaning it's taking on a little bit more risk, but the expected return is a bit higher as well. And so that leads us to say, okay, what is the expected return that we are likely to generate from this portfolio? And that's what you can see here in the forecasts. So I mentioned that the current portfolio is underweight fixed income and overweight equity by design. So when we raise cash on a quarterly basis and we make a recommendation to, sell $100,000 of XYZ mutual fund, we are intentionally maintaining an overweight to equities and an underweight to fixed income. Again, it's all within the allowable parameters of the investment policy statement. It's not a huge shift in one direction or another, but it's a nod to the current environment and saying, okay, we understand that fixed income is not particularly attractive. We feel more comfortable having our, more of the portfolio exposed to equities. So the actual makeup of the portfolio right now with that underweight to fixed and overweight to equities is likely, according to our capital market assumptions, likely to generate a return of about 6.3% over the very long term. We go back to that actuarial return assumption of 6.375. you do use some active management in the portfolio, so there is the potential for alpha above that asset class return. So we think that the current portfolio is appropriately positioned and that the return expectation or the return assumption of 6.375 is reasonable and justifiable. So I will stop sharing the screen for a moment and see if there are any questions about any of that or anything I can further explain. No? Okay. All righty, so let me go back to sharing. Okay, everyone can see again? All right. So we do have one portfolio recommendation to make. We are recommending eliminating the Eaton Vance Atlanta Capital SMID Cap Fund and replacing it with the Conestoga SMID Cap Fund. The Eaton Vance Fund has kind of been on our radar screen collectively for a while. I know that we've talked about it at past meetings. The performance has been very weak, substantially under the benchmark, and weak compared to the peer group. That was something that we understood, and it was kind of expected given their investment process, where they benchmarked themselves to the Russell 2500 Core Index, even though it was a growth strategy. So their sector allocation was more in line with the core universe. They tended to be overweight financials, underweight technology. So we understood the rationale for the underperformance. However, the magnitude of the underperformance got to the point where it was just something that we were no longer comfortable with. And furthermore, Patty, going back to our earlier conversation before the meeting started about mergers and acquisitions really across a variety of industries, that's been happening in the investment management industry, and Eaton Vance is being acquired by Morgan Stanley. So that organizational shift combined with the relative underperformance led us to initiate a watch status. It's not on terminate status yet, but my recommendation is I think that we're moving in that direction. So my recommendation is just to get out, replace the Eaton Vance Fund with the Conestoga Fund. We do have all of the relevant information. So page 16 tells a little bit about the process, and then you have all of the historical performance data. One thing that I will bring to your attention is the up-down market capture ratio. So over a 5-year basis, and I'm looking on page 23, the Conestoga Fund has captured about 98% of the upside, but only about 87% of the downside. So it does offer a bit of downside protection and certainly will participate in up markets. It has a high quality approach. The Eaton Vance Fund, candidly, also had a high quality approach, but this fund is more likely to perform more closely to the benchmark and to other peers. So you're not likely to have as much tracking error as the Eaton Vance Fund had because of its the sector allocation of the Eaton Vance Fund was a bit unusual. So certainly happy to go into any details. The returns for the Conestoga Fund are attractive over time. You're looking at a 5-year annualized return of almost 21% in the top quartile of the peer group, well ahead of the benchmark. So that is our recommendation. So I again will take down the screen and see if there are any questions, or if you want to take a vote on that now, or if you want to hold the vote until after.
I have a question just on the recommendation. So understanding the challenging performance and trying not to make decisions based strictly on performance, even given the magnitude here, it's pretty stunning. Given the merger that you referenced, so Morgan Stanley's acquisition of Eaton Vance, isn't the strategy managed by Atlanta Capital?
Yes, it is. Yep.
So I'm wondering if there's any impact. Yeah, I'm wondering if there's any impact at that level, and then if there's anything else that gives pause moving forward with this strategy relative to Conestoga.
Yeah, there shouldn't be, Elliot. So this would be the type of, if we were to take the underperformance and set it aside completely, this would be kind of a procedural watch status where you kind of have to do it because there's a significant organizational change, but it would be watch, leaning, maintain. So it would be our expectation that we'd just keep an eye on it for a couple quarters. We would expect that things would go smoothly, and then we'd move it back to maintain status. So it's really the combination of the significant underperformance along with the organizational shift. And it's the performance that's driving the lean towards terminate status rather than back to maintain. Yeah, so it's our expectation, you know, the party line has been, oh, nothing will change. The portfolio management team is going to be able to do what they've always done. There shouldn't be any change in procedure or investment philosophy. So we don't expect the acquisition by Morgan Stanley to have a big impact, but that's just kind of part of our process. Is anytime there's an organizational shift like this, it does typically warrant a watch status, but it's the performance that's really more concerning.
Okay. And then the only other question would just be regarding Conestoga and how it fits within the rest of the portfolio. So, you know, based on the analysis, it looks like, you know, beneficial relative to the strategy that is being recommended to be replaced. So Eaton Vance, but how does it fit with the rest of the portfolio?
Yeah, that's a great question. So I'll actually flip ahead and we can look, let me share my screen again. We can look at the portfolio. So we think that it's a good complement to the Diamond Hill fund. So we've got the Diamond Hill small mid-cap fund on the value side, and then the Conestoga fund would replace the Eaton Vance on the small and mid-cap growth side. Those two strategies are frankly more complementary than the Diamond Hill and the Eaton Vance fund. Simply because the Eaton Vance fund did have that sector allocation that was in line with the Russell 2500 core index rather than the growth index. So Diamond Hill benchmarks and manages its portfolio against the Russell 2500 value. So now the Conestoga fund will be against the Russell 2500 growth, and we think that the two portfolios will be better complements to each other than the current Diamond Hill and Eaton Vance. And then for the rest of the domestic equity portfolio, we've just got the Vanguard Institutional Index, which is the large cap exposure, tracks the S&P, and then we combine that with the Vanguard Value Index. And that is because of a couple things. First is the dislocation between growth and value, where growth has really outperformed in recent history, and it's our expectation that value will come back into favor. Value stocks look much cheaper than growth stocks, and we actually saw that start to come to fruition in the fourth quarter. And also with the way that the index, you know, the strength of growth stocks within the S&P 500 index means that the index itself leans more growth. So to have the value complement kind of neutralizes that what might be an unintended style bias towards the growth side. So we think that it fits in very well with the current portfolio.
Good. Thank you.
Sure.
Devin, this is Patty. Were there any other options you looked at in addition to the Conestoga fund, or are we limited based on our platform? Just curious whether you looked at others and this one was the top of the heap of funds to replace it.
Yes, you are not limited. So it's completely open architecture. We can get access to any mutual fund. This is the preferred strategy that our research team likes. So this is the top of the list in terms of what we like and use.
Okay, thank you.
Sure. Any other questions?
So do we want to move to potentially look for a vote now to make this change now? It seems that given the performance as well as the change with the acquisition, it seems like now might be the best time. So I guess I will look, if people are supportive, for a motion to terminate the Eaton Vance fund and replace it with the Conestoga fund.
So moved.
Thank you, Tim. Can I have a second?
Second.
Thank you. Any other discussions or questions?
Devin, I guess the only question I have is the Conestoga looks like it's, from the charts I'm looking at here, they're only 5 years old. Is that any concern?
That's not a concern for us, Tim. Nope. Usually we, kind of draw a line in the sand. We typically don't invest in any strategies that are newer than 3 years old, but 5 years, we're comfortable with that kind of track record.
Okay.
Tim, I'll also just add, just for everyone's comfort and benefit, I think Conestoga and the strategy have been around much longer than 5 years. It's just the vehicle that we're investing in, but the strategy itself has been run much longer.
Yep.
Oh, that helps. Thanks, Elliot.
Yep.
Okay, any other questions? Okay, all in favor of making this change?
Aye.
Anyone opposed? Please state your name and that you're opposed. Hearing none, the motion carries to make the change to terminate Eaton Vance and replace it with the Conestoga Fund.
Devin, how long will that take to implement?
Couple days, we can get it done by the end of the week.
Great, thanks.
No, Devin, the only question is in terms of notifying plan participants and going through that whole process again, do we need to do anything for that or?
No,
Okay.
At all, because this is the defined benefit plan, there's no need to notify.
So that works well for me. Thank you.
yes.
After the last time, that works perfectly.
Yes, yeah.
They have the defined contribution plan where they get to pick investments, not the defined benefit plan.
Right.
Yep. Okay, excellent. So we will get going on that paperwork and Patty will send whatever needs to be signed your way.
Okay.
So I'll just spend a couple more minutes. I know we've got to move on to the other items in the agenda. Just very briefly, I mentioned that 2020 was a great year for equity markets. So if you had fallen asleep at the end of 2019 and woken up at the end of 2020, didn't know what happened in the world, and you just looked at these returns in the 1 year column, you probably would have thought, hey, like this was the best year in the history of the US economy. Look at these numbers. And we all lived through March and we know that decidedly that was not the case, but the numbers really belie the overall environment. So really very strong returns across the board. You do see that the value areas of the market lagged. So for instance, the Russell 1000 value only up 2.8% on a 1 year basis compared to the growth, which was up 38.5%. But you do see that value actually came back in the fourth quarter. So I mentioned that already. The value index was about 5 percentage points ahead of the growth index in the fourth quarter. You also saw a rebound in small caps in the fourth quarter. So the Russell 2000, the 2000 growth, and the 2000 value all up around 30% or more for the fourth quarter, which actually brought them ahead of the S&P 500 for the year. But really, just universally strong returns across the investable universe on the equity side, and then also very strong returns in the fixed income side. And again, that was mostly driven by price return as interest rates came down over the course of the year, really across the fixed income universe. You had very strong returns in fixed income. So, diversified portfolios performed very, very well over the course of 2020. Looking forward for the next year or so, we continue to be optimistic about, prospects for returns. We think that with the vaccine rollout, unless there are any significant bumps in the road that perhaps we're not anticipating, we think things should kind of return to some semblance of normalcy maybe midway through the year. So you're likely to see the economy be propped up by that return to normalcy, and markets will likely follow suit. We also expect a fair amount of fiscal stimulus from the Biden administration, and then the Fed has indicated that they will remain accommodative. So, from the combination of fiscal stimulus and accommodative Fed, and then resurgence in economic activity, it should bode pretty well for the coming year. if we hearken back to the capital market expectations, it's the longer term environment that does seem a bit challenging to us. But in the interest of time, I'll move ahead. We see the portfolio on page 34. So we ended the year at about 40.2 million. And again, I mentioned that we are a bit underweight fixed income and overweight the equity areas of the marketplace. That is by design, but still within the parameters of the IPS. We already made the decision to eliminate this Eaton Vance fund and replace it with Conestoga. Other than that, there are no recommendations for any changes to the portfolio. So we still like the makeup of the fixed income segment of the portfolio. It's very well diversified. It has exposure away from US interest rate risk. So if we do enter a rising interest rate environment, we're likely to see some protection and some diversification from this BlackRock fund and the Brandywine fund. So we think the fixed income portfolio is well constructed. And then on the international equity side, we've got some indexing, and then we've got some active management in both the large cap and small cap, and as well as dedicated emerging markets. And then finally, the last piece of the portfolio is the principal diversified real asset fund, which we added, I think, early last year. And that fund, you know, in and of itself is fully diversified exposure to the real asset market. So it has TIPS, commodities, natural resource equities, infrastructure, real estate. So it's got exposure really across the board, very, very diversified exposure. So on page 36, we can see the performance for the quarter. The portfolio was up 11.3%, about 50 basis points ahead of the benchmark. And then we also have the fiscal year-to-date performance. So for the last 2 quarters of 2020, the portfolio was up 17.5% versus 16.1% for the benchmark. So some strong outperformance in recent months. But on a 1-year basis, we are still behind the benchmark, and that is largely driven by the small cap exposure. The Eaton Vance fund in particular had, of course, we already talked about the relative underperformance. So that's what drove a lot of the relative underperformance for the total portfolio. And then we also did have that sliver to the value index. And remember, value has underperformed growth. In an accelerating economic environment and the potential for rising inflation, value stocks should perform well. So we continue to like that profile, but that has been a relative headwind in recent history. But if you look at the absolute numbers, you know, on a since inception basis, and this goes back a very, very long time to the history of the plan in 1980, but you've produced a return of 8.3% per year. Even with the fact that the actuarial return assumption used to be higher, your plan has been able to, you know, keep up with those return assumptions over time. So certainly some strong absolute results in keeping with what the actuary expects. So I'm happy to go into any of the specific manager strategies, but in the interest of time, we may want to move on to the other items in the agenda, but certainly I'll open it up to questions.
I'll just highlight one good thing, Devin, because I think we discussed it a few meetings ago, was on Brandywine, who at that point in time was the worst performing manager in his peer group. And we decided to stick with them, and since that decision, they've been the best.
Yes.
So just something worth highlighting, I think.
Yep. Thank you for pointing that out. Yeah, it's funny how, you know, just a point in time and things can change so drastically. And Brandywine is not ever going to look like the benchmark. That's not their objective. And so, you know, when you have an endpoint, sometimes they'll be in the 100th percentile, and then sometimes, like right now, they'll be in the 1st percentile. So over time, if there are more instances where they are in the top half, then that leads to outperformance over time. So thank you for pointing that out. And yes, we are thrilled with their recent performance.
Yeah, just particularly important given what you talked about earlier with the bleak picture for fixed income returns.
Right. Absolutely. Any other questions or comments?
Okay, thank you, Devin.
Thank you.
Hearing none, I will go to the next agenda topic, which is a discussion on environmental, social, and governance investing, ESG. And this was prompted by a resident asked a question of the first selectman about what is the town's policy and management of its retirement plans with regard to ESG. The first selectman reached out to me and also Tim from some historical perspective. I think our response is we don't have one, I believe, was kind of the statement at this point in time. So we had a discussion between the first selectman, Devin, and myself to really just talk about the landscape around ESG and specifically in municipalities. And at a high level, from Devin's perspective, people are focused on performance, so results and performance. And most municipalities don't really do a lot around ESG, certainly. So we wanted to just tee that up, and I'll let Devin share a little more insight and one possible option we might consider that's kind of a high level statement we could potentially put in our investment policy statement. So I'll let Devin share a little bit more.
Sure. Thanks, Patty. Yeah, so Patty and Danielle and I had a conversation kind of about the broad ESG landscape in general. So we at DeMayo Schneider have a committee, we call it the Mission Aligned Investing Committee, that focuses on the ESG space. We're doing a lot of work in that space, and we do see a lot of interest. It's particularly on the endowment and foundation side, and also a lot of 403B plans, like university defined contribution plans, tend to be interested in ESG investing. We have not seen a big uptick in municipal plans, either on the pension side or the defined contribution side, that are using ESG investing. But that's not to say that, the trend won't move into that space. Municipal plans tend to be kind of a little bit behind the trend line. So certainly there's been a lot of increased interest generally in the marketplace for ESG investing. I think some of the data seems to be, for a long time, there was this conception, or perhaps a misperception, some would say, that in order to incorporate ESG investing, you have to sacrifice performance. Over time, it seems that that's not necessarily the case. Now you can slice and dice the data in all manner of ways, so I'm sure you can find a way to make it look like there is a performance sacrifice associated with ESG. You can find a way to make it look like there's a performance advantage. So you just need to go in with eyes wide open. But there are really a number of ways that you can go about incorporating ESG. So, do you want to have an integrated approach? So an investment philosophy that kind of optimizes exposure to the kind of good actors in the space. So the companies that are behaving the best in terms of environmental, social, and governance criteria. Or do you want to have an exclusionary ESG process where you exclude certain sectors, certain companies based on their behaviors? So really, it's a very broad spectrum. And the most important thing in terms of beginning an ESG process is really defining, okay, what are the values that we want to be expressed through the portfolio? When Patty and Danielle and I spoke, is it really appropriate? So I mentioned that we've seen a lot of uptick in ESG investing in the endowment and foundation space. And many times those organizations can align their own mission statement with the way that their portfolios are constructed. So if it's a health-based organization, they might not want to have exposure to tobacco and alcohol, and that's directly aligned with their mission. With a municipal asset pool, it gets a little bit dicey in terms of defining what the value set is. So one of the things that I mentioned to Patty and Danielle is that we could incorporate just very, very broad language into the investment policy statement something that says, the plan may consider the use of environmental, social, and governance issues when investing plan assets, but is not required to do so. And then you could go on to say that these strategies will be held to the same due diligence criteria as non-ESG strategies. And that, I think, is the most important thing, is that you don't, going back to the concept of sacrificing returns, there are a lot of ESG strategies, particularly the inclusionary ones, where investment managers believe that by incorporating ESG criteria into the investment process, that they will enhance returns and mitigate risk. So they kind of, eliminate some of the headline risk associated with the quote unquote bad actors in the space. But it's important that you don't make ESG the primary criteria and then performance doesn't matter, or the other things don't matter. So, they all need to go hand in hand. And I think if you were to add language like that to your investment policy statement, it could kind of open the door to an ESG discussion. And, if let's say we had a manager recommendation for you, we could bring to the table maybe an ESG strategy and a non-ESG strategy, but it doesn't make you beholden to following any sort of specific guidelines. So, really, there are a lot of potential avenues. As Patty said, we haven't seen a lot of municipalities, quite frankly, I haven't seen any that have incorporated ESG into their portfolios, but that's not to say it can't be done, and that, eventually we won't see the municipal space move in that direction. I think we're likely to see a lot of increased use in ESG really across the board over the next 5-10 years or so. So I don't know if there are any questions for me. I mean, that's just, it's very vague. There are a lot of avenues that you could move in. So I apologize for not having anything, distinct. There's no distinct recommendation here, but I know that Danielle did want the board to begin kind of talking about this conceptually.
Yeah, Devin, let me jump onto that from a legal perspective. We all know that ERISA doesn't apply to municipal pension plans, which is a good thing, because there was a proposed rule near the very end of the prior administration, which would basically say, with respect to ESG investments, you can't look at the ESG aspect, you can only look at performance. That rule has been put on hold by the current administration and probably will not survive. However, as I said, those rules don't apply, although people sometimes look to ERISA governing, your fiduciary duties and what you do with investments. So right now, you really have no restriction. It's likely that there will be no restrictions on your ability to select an ESG investment. But as Devin says, performance is important too. It shouldn't just be, you shouldn't look at it in a vacuum.
I'll add a few thoughts on the topic. It's something that I'm discussing almost daily on behalf of my firm, both inbound and more proactively. But I think Devin highlighted it really well with, just as a municipal pool of assets, it's just tough, given we represent varying values and objectives of our members. So we don't really have a singular mission that we're trying to implement, whether it's environmental or social, whatever. And I think the primary objective function as fiduciaries really is making sure that the DB plan performs with suitable levels of risk, and that should be primary. But my understanding in working with the Mayor Schneider historically is ESG is something that they're considering when they're evaluating every manager that they talk to. So every manager that we've invested with in our portfolio is being asked about how they integrate or implement ESG in their investment process. And perhaps that's something we just want to highlight in our language or in our documents somewhere, where it's something that's being taken into consideration by our consultant when they speak with, whether it's Diamond Hill or Franklin Templeton or whoever we're invested with. Our consultant has a good understanding with at what part of their investment process they're considering ESG, whether they're doing it inclusionary or exclusionary, or it's just where it is in their investment process or philosophy. So I think we can highlight that before diving in any deeper on a dedicated basis into the topic. But I think we're understating what our ESG integration is, because it's already probably in the portfolio in some extent.
Oop, Patty, you're on mute.
Patty, you're muted.
So, Devin, I did look at your the contract, you know, with DeMayo. It was probably FIA at the time. Is that anything you have in some of your contracts that may be specifically called out as a kind of line item within your contracts?
No, it's not specifically referred to in the contracts, but
Okay.
Elliot is exactly right, that
Okay.
it's part of our conversations with
Okay.
our manager. Yep. So it's something, you know, to do this work is not any additional fee. It's all part of
It's
the
all done.
process.
Okay.
Yep.
So other questions and comments, it seems like at this point, the view is kind of leave it as is. DeMayo does look at that, to Elliot's point. It's part of what goes into their overall review. And for now, kind of leave it at that in terms of what we want to do from a retirement board.
I'd support that. You know, I almost want to recuse myself from this conversation because we sell to oil and gas primarily and the military. So I have a vested interest in not excluding some of those things. But I think that Elliot's right, saying that DeMayo Schneider's already doing that kind of a evaluation covers it as of now. And Bruce saying that we don't have a legal obligation. I think we just probably can state that it's being done, but not in a very public kind of way.
Okay. Other comments from any retirement board members? Okay. Okay. Thank you, Devin. That was, I appreciate that conversation.
Sure.
The next item, which is going to be pretty quick, is investment policy statements. So we do not currently have one for our defined contribution plans. We probably should. In talking with Devin, most, you know, municipalities do have an investment policy statement. She had drafted one, and I didn't want to bring it to this meeting pending the ESG conversation, but we would bring that to the May retirement board meeting for review and approval. And we'll probably just take another look at the DB investment policy statement. That'll be around 3 years since that was approved. So probably a good time to relook at that one as well. And then the intent would be to bring both of those. If there's any changes on the DB side, bring that to the May meeting, and then bring a draft investment policy statement for the DC plans also to the May meeting. But Devin's firm has drafted a high level one for the DC plans, and we can look at that in our May meeting. So that's a quick agenda topic. And the last one, well, the second to last one, I had a discussion approval. I was hoping it would be approval, but I don't have all the information yet. So to give you the background, when we put the 401A plan in place back in 2013, we had an adoption agreement. We did not have a town of Stonington specific summary plan description. It was a generic governmental SPD. We don't send that out to participants. We give them a 3 or 4 page summary of the plan. So we never had a town specific SPD at the time. Back in early 2020, the town signed a contract with pension consultants to help with the administration on the 401A plan. And as part of that, they prepared an SPD specific to the town in a revised adoption agreement. I've reviewed it. I had some questions on it. Bruce's firm has reviewed it, had some similar questions. I've gone back to pension consultants on a few outstanding items in terms of why they made some changes in there that they made. I have not yet heard back and gotten the final information. I was hoping to have that for this meeting, but in the absence of that, that will also be for the May meeting. So it would be a revised adoption agreement for the 401A plan, a town of Stonington specific SPD. At that point, we would send that out to all plan participants, and we would also give that to new hires. So there were just a few outstanding items on that I was unable to get resolved in time for you all to see it and in time for this meeting. So I keep adding things to the May meeting agenda It's going to be a long meeting, so just an update on that. But when we were trying to look at the 401A plan, we never had a town-specific SPD for that plan. And considering that really is the go-forward plan, if you look at it going forward, that really is our go-forward retirement plan as people retire, new hires come on board. Between that and the 457, those are our retirement plans going forward. So just a heads up on that. I was hoping to have a approval, but alas, it's just a discussion. And I think before we get to the next topic, I think Devin is going to sign off. So thank you, Devin, for everything.
All right, thank you, and I'll see you all in May. Thanks.
Bye.
Bye,
Bye-bye.
Devin. Thank you. So the last topic is the engagement of actually DeMayo Schneider on the defined contribution plans. So back in, I believe, 2016, the retirement board approved engaging FIA at the time, DeMayo Schneider, with oversight, financial oversight on the 401A and the 457 plan. At the time when the town signed the contract, the plans were both pretty small, and we actually signed for a once-a-year only review. So it's a contract for $15,000. It's only a once-a-year review of both plans. And that came up when we talked about it at our December meeting, moving to quarterly meetings. Devin highlighted that we only review your DC plans once a year. Based upon the fact that those plans are going to be our growth plans going forward, and based on Bruce's review at the December meeting on the fiduciary responsibilities for DC plans, I would like to sign the full service agreement with DeMayo for the defined contribution plan. So currently it's $15,000 for a once-a-year review. It would be $25,000, similar to the DB plan, for the full service review of the DC plans. When I talked to Bruce, he wasn't sure whether I needed formal approval from the retirement board, since the board already approved engaging DeMayo Schneider in the first place. But I did want to bring it to the retirement board. I think going forward, these plans are going to continue to grow. They will be the retirement plans for the town. And I think having, and based on Bruce's review of our fiduciary responsibility, I think having DeMayo Schneider do the quarterly reviews makes the most sense. Today, their fees are paid out of the forfeiture account for the DC plan, which has roughly $62,000 in it today. At some point, if there is not money in the forfeiture account, that'll be a town expense. But for now, that money does come out of the forfeiture account. So I just wanted to mention that. I ask any questions or comments, I'm more than welcome.
Is anything else coming out of the forfeiture account?
Excuse me?
Anything else coming out of the forfeiture account?
Some of Robinson and Cole's legal fees, if they're specific to that plan.
Yeah, and the forfeiture account can be used to pay administrative expenses, to reduce employer contributions, or could be reallocated to participants. You probably don't want to go down that road. The other thing is, if these expenses exceed the amount in the forfeiture account, you could charge them against plan participants' accounts. You don't have to. You know, the town can certainly pay them, but if the town wanted to, it could charge them against the participants' accounts. And as this plan grows, the expenses are going to become a smaller and smaller fraction of the plan.
And Tim, just so you know, there is a line item in my department's budget for these fees. We obviously last year, we haven't had any money against it, but it is a line item that sits in my budget.
Yeah, we had this discussion back when we engaged FIA, now DeMayo, originally. And my feeling was that if we had the forfeiture account, it should come out of that for the fees, because it really ought to be against the people that are getting the benefit out of it. But I just wanted to, as Bruce notes, we use the forfeiture account for my company's personal retirement fund for different things, but we try and limit it so that it offsets fees, because that's kind of the in my opinion, the more appropriate way to do it, because then the people who are getting the benefit are also getting the costs that are associated with.
Any other comments, questions?
So one question just on the frequency. So we're going from one annual meeting that covers the DC plan to 4, correct? It's not.
Yeah, they will do the review. It depends how much
Okay.
we want to cover it in the actual meeting, but they will do a quarterly review on our DC plans.
Okay. Just curious, any reason why quarterly versus semi-annual? And the only reason I'm asking that is just given the nature of the DC plans. I know they're under certain levels of scrutiny, but they tend to be much more streamlined and less complex from like an oversight perspective, because it's just looking at participant directed manager allocations versus, doing asset allocation and, work with Hooker and Holcomb and all of that.
Yeah, I have to ask. I don't know whether there's a fee in between the two. Elliot, that's a good question. I can ask
I
Devin
don't believe
that.
there is, Patty.
Excuse me?
I don't believe there is, no. I think it's certainly included in FIA's, DeMayo Schneider's cost. I assume it would be included in Hooker and Holcomb's as well.
Right. No, I'm just saying we wouldn't be using them for the DC plan, right? It's just much
Right.
less. There's no asset
Yeah,
liability work done.
I think what you're asking, Elliot, though, is there a reason we don't try to go to twice a year versus 4 times a year, and is there a cost difference? Is that your question?
Correct. Yeah.
So I can ask that question. They'd given me the kind of full service. It's the full service fees for the DC plan. I don't know if there's something in between the two that would be a twice a year review, but I can check with Devin on that.
Okay. Yeah, and I'm not against having 4 meetings. I just think there's much less to do in terms of oversight of a DC plan.
Now, question is, do you is this a decision that I can make in my role? Do you want to take a vote on it? I will defer to you all. Bruce didn't think technically I needed to do a vote because you all approved using them back in 2016, but I'll defer to whatever the retirement board wants to do.
I think that we had hesitation from some members of the retirement board back in 2015 and 14 about taking on this plan, but I think fiduciarily we have to. So I am very comfortable with you engaging them once we know the answer to Elliot's question, going forward with that. I don't think we need a motion.
Yeah, I'd agree. Once there's just more clarity on that, certainly comfortable with you making the decision, Patty.
Yeah, and I will get that information, from Devin and let you all know as well. And again, the DC plan going forward, if I just think from a town perspective, and the Board of Ed also is in our 401A plan, but, we hired probably 8 new people, in 2020 who all went into the new plan. So, more and more of those plans are going to continue to grow and become our, 5 years from now, they're going to be much bigger. They're going to be the retirement plans for the town. So, and again, I think Bruce's presentation in December just highlighted the fiduciary responsibilities we have for those plans. So thank you very much for your support. Anything else from anyone?
I have one thing just on the ESG question that came in, because I think it's not the last we're going to hear of this, if my experience is any indicator. One thing I'll ask Devin is on DeMayo Schneider, and this could be helpful in answering any questions we get going forward. If they've signed the UNPRI, which is the United Nations Principle for Responsible Investment. So if we're retaining a consultant that is proactively doing this, I think that's one way that the town has implemented an element of ESG. Also can get some information from her on, as an employer, how they approach topics like diversity and inclusion, things like that factor into the social element of ESG. So beyond just the managers that we're hiring and the investments we make, also the consultant that we've retained. So they should have that information readily available for any RFP they're responding to win any new business. So they can share that with us. We'll be better equipped to answer the question more completely moving forward, I think.
Okay, I will follow up with Devin on those items and get back to you all as well.
Elliot, and by the way, Elliot, great point in that regard on the DEI situation. Just so you know, Patty, our firm is certified under the Mansfield rule, which is the DEI for law firms, effectively.
Great. Thank you. Any other topics from anyone? Can I have a motion to adjourn the meeting?
So moved.
Second.
Second.
All in favor? Okay, the meeting is adjourned at 10:06 a.m. Thank you very much, everyone.
Have a great
Thank
day,
you.
everyone. Be careful out there.
Or just have fun.